The Misbehavior of Markets by Benoit B. Mandelbrot and Richard L. Hudson. Picture an ordinary summer day in August 1998. Wall Street was about to witness the impossible. A sense of unease crept through the financial district. Japan's economy was stumbling, China's currency was wobbling, and Russia, the darling emerging market everyone had been betting on just months before, was running out of cash. On August 4th, the Dow Jones plummeted 3.5%. A few weeks later, as Moscow's troubles deepened, it dropped another 4.4%. Then came August 31st, a day that would make history, when the market crashed 6.8% in just one trading session. Wall Street went into full panic mode. Analysts were throwing around words like meltdown. One expert grimly predicted it might take investors a lifetime to recover their losses. But here's where things get really weird. According to the sophisticated financial models taught at every top business school, the same models running on supercomputers at the world's biggest banks, that August 31st crash should have been virtually impossible. The mathematical odds? 1 in 20 million. You could trade stocks every single day for nearly 100,000 years and never expect to see a day like that. And 3 such dramatic drops in a single month? The odds ballooned to 1 in 500 billion. The financial world dismissed it as a freak accident, an act of God. But was it really? Because here's the uncomfortable truth. In financial markets, the supposedly impossible happens with disturbing regularity. Just 1 year earlier, the Dow had plunged 7.7% in a single day, an event the models said had a 1 in 50 billion chance of occurring. And Black Monday, October 19, 1987, saw an absolutely devastating 29.2% collapse. What were the odds of that happening according to standard financial theory? Less than 1 in 10 to the power of 50. That's a 1, followed by 50 zeros, a number so incomprehensibly large, it might as well describe the number of atoms in multiple universes. So what on earth is going on? We're constantly told that markets are rational, efficient, and predictable to some degree. Prestigious universities teach elegant mathematical formulas designed to help us manage risk and construct the perfect portfolio. Yet time and time again, the real world seems to laugh at these theories, tear up the rulebook, and set it ablaze. For over 40 years, one maverick genius stood apart from the crowd, seeing what others couldn't. He wasn't an economist or a Wall Street hotshot. He was a mathematician who studied nature's beautiful chaos, the roughness and patterns hidden in coastlines, tree branches, and turbulent rivers. His name was Benoit Mandelbrot, and he discovered that the same mysterious laws governing these natural phenomena also controlled the wild swings of financial markets. Today we're diving into his groundbreaking book, The Misbehavior of Markets. This isn't your typical dry finance textbook. It's a story about revolutionary ideas and a completely new way of seeing the world. By the time we're done, you'll understand the hidden geometry of risk, why markets crash, and why the financial world is far wilder and more fascinating than anyone has admitted. You'll learn the secret language of markets, not to predict them with certainty, but to finally, truly understand what makes them tick. To grasp the revolution that Benoit Mandelbrot sparked, we first need to understand the established world he challenged. For nearly a century, the entire field of finance rested on one beautifully simple idea that started back in 1900 with a young French mathematician named Louis Bachelier. Back then, serious mathematicians didn't waste their time studying stock markets. It seemed messy, grubby, and hopelessly unpredictable. But Bachelier had a stroke of genius. He suggested we think about stock price movements as a, quote, random walk. Picture a slightly tipsy man stumbling across an open field. He staggers left, then right, lurches forward 2 steps, stumbles back 1. His path is completely random. You can't possibly predict where he'll be in 10 minutes. But here's the thing. Your absolute best guess is that he'll end up right back where he started. Bachelier proposed that financial markets work exactly the same way. Tomorrow's stock price is just a random step away from today's price. Your best forecast for tomorrow? Simply today's price. This elegant idea became the bedrock for what we now call the efficient market hypothesis, the theory that all available information is already baked into current prices, making markets perfectly fair and fundamentally unpredictable. But there was another critical piece to this puzzle. Bachelier and his followers assumed that the size of these random price steps followed a very specific pattern, one so common in nature that mathematicians simply called it normal. We know it better as the bell curve. Think about measuring the heights of soldiers in an army. Most cluster around the average height. A few are somewhat taller, a few somewhat shorter. Extremely tall or extremely short soldiers are exceptionally rare. Graph this out and you get that classic bell shape. According to the theory, stock market changes followed this same pattern. Most days, prices would barely budge. Very, very rarely, they'd make a big move. Mandelbrot would later call this comforting view mild randomness. It suggested that risk was something you could precisely calculate, measure, and control. On this foundation, the entire elegant house of modern finance was constructed. In the 1950s, a young economist named Harry Markowitz tackled a fundamental question: what exactly is risk? He answered it using the bell curve, defining risk as variance, a statistical measure of how much a stock's price typically swings around its average. The wider the bell curve, the riskier the stock. With this insight, he created modern portfolio theory, a mathematical recipe for mixing different stocks to achieve the highest possible return for the lowest possible risk. Then in the 1960s came William Sharpe, who streamlined Markowitz's work with his capital asset pricing model, known as CAPM. He introduced the how much a particular stock tends to move relative to the entire market. With beta, you could calculate exactly what return you deserved for accepting a certain level of risk. Finally, in the 1970s, came the crown jewel, the Black-Scholes formula. Fisher-Black and Myron-Scholes created a brilliant equation that could put a precise price tag on risk itself. It allowed traders to value stock options, those contracts giving you the right to buy or sell a stock in the future. This formula was like financial alchemy, fueling the explosive growth of the derivatives market and explaining why so many executives get paid in stock options. This was the old way, a beautiful, elegant, mathematically coherent world. Its message was crystal clear: risk is measurable, manageable, and can be tamed through clever mathematics. It became sacred orthodoxy, taught at every business school and programmed into computers at every major bank on Wall Street. There was just one tiny problem. It was completely, utterly wrong. This is where our hero, Benoit Mandelbrot, enters the story. Mandelbrot was a true maverick, someone who thought in vivid pictures rather than just abstract formulas. He spent his life, as one friend put it, moving orthogonally, at right angles to every fashion and trend. His independent character was forged in the crucible of World War II, when as a Jewish teenager he hid in the French countryside, learning early that independent thought could mean the difference between life and death. He tells a powerful story about his father, who found himself in a prison camp. One day resistance fighters attacked and told the prisoners to flee. The disoriented group instinctively headed together down the main road toward the nearest town. But Mandelbrot's father stopped and thought. This is madness, he realized. He broke away from the group, left the exposed road, and slipped into the thick forest to make his own way home. Shortly after, he heard a German dive bomber strafing the main group on the road. Alone in the forest, he survived. He was an independent man, Mandelbrot recalled with obvious pride, and so am I. This fierce independence led Mandelbrot to see what the entire financial establishment was blind to. He didn't see markets as neat, orderly machines. He saw them as wild, rough, and turbulent. Mandelbrot invites us to play a fascinating game. He shows us 4 price charts, with all dates and labels stripped away. 2 are genuine historical price charts. 2 are clever fakes generated by computers. The challenge: can you spot the forgeries? At first glance, they all look remarkably similar. They wiggle up and down with peaks and valleys. But then he shows us another set of charts displaying not the prices themselves, but the changes in price from one moment to the next. Suddenly the forgery jumps out like a sore thumb. One fake chart is incredibly well-behaved, almost boring. The price changes are mostly uniform, like a freshly mowed lawn. There are a few taller blades of grass, a few bigger changes, but they barely stand out. This chart, Mandelbrot reveals, was generated by the orthodox random walk model, the coin-tossing view of finance beloved by traditional economists. It's the world of the bell curve. Then you look at the real charts, one showing IBM stock and another a currency exchange rate. These look nothing like that neat lawn. They're wild, like an untamed forest, with trees of wildly varying sizes. Long stretches of small undergrowth suddenly give way to gigantic sequoias, those huge, towering price swings that seem to cluster together. This isn't mild, gentle randomness. This is something entirely different. The 4th chart, the other fake, looks just as wild and clumpy as the real market data. It's a perfect ringer. This one, Mandelbrot explains, was generated by his model of the market. The fact that it creates such a convincing forgery is the first major clue that he's discovered something profound. The central problem with the old way of thinking, Mandelbrot argued, was its blind reliance on the bell curve. Real market returns simply don't follow the bell curve. The tails of the distribution, those parts representing extreme events, are much fatter than the bell curve predicts. Let's put some hard numbers on this. From 1916 to 2003, the bell curve predicts there should have been roughly 58 days when the Dow Jones Index moved by more than 3.4%. In reality, there were 1,001 such days. The theory predicts 6 days of swings greater than 4.5%. Reality delivered 366. And those dramatic swings exceeding 7%? According to theory, that should happen about once every 300,000 years. During the 20th century alone, it happened 48 times. The standard theory simply fails catastrophically to account for the wildness of the real world. Instead of a bell curve, Mandelbrot discovered that price changes often follow something called a, quote, power law. This revelation came from solving the mystery of cotton prices. In 1961, while visiting a professor at Harvard, Mandelbrot noticed a strange diagram on a blackboard. It looked almost identical to a chart he'd been working on, describing how income distributes across a society. Curious, he asked what it was. "That's not income," the professor said with frustration. "That's cotton prices. They make absolutely no sense. The volatility keeps changing unpredictably. It's a complete mess." Mandelbrot was instantly hooked. Why would the distribution of wealth in society follow the same mathematical pattern as price fluctuations in cotton? He dove deep into the data and found that both phenomena followed a power law discovered a century earlier by Italian economist Vilfredo Pareto. Pareto's law describes how a tiny percentage of people control a massive proportion of wealth. We often call it the 80/20ths rule, though the exact numbers vary. In this world, the super-rich aren't just a little wealthier than the merely rich. They're orders of magnitude wealthier. It's a world defined by extreme inequality, where the extremes dominate everything. Mandelbrot realized financial markets operate exactly the same way. Price changes aren't all small and uniform like grains of sand. They're a chaotic mixture of sand, pebbles, rocks, and massive boulders. A few gigantic price moves, those massive boulders, can have greater impact than millions of tiny fluctuations combined. This is the world of wild randomness, and it's the first of 2 major effects Mandelbrot identified, which he calls the Noah effect. Think about the biblical story of Noah and the Great Flood. The flood wasn't just a bit of extra rain. It was a catastrophic, discontinuous event that changed everything in an instant. Market crashes work the same way. They're not just large deviations from the average. They're qualitative breaks with the entire past. The standard financial models, with their gentle bell curves, completely exclude the possibility of a Noah-style flood. But in the real world, these floods arrive regularly. This discovery alone was revolutionary. It meant that risk had been systematically and dangerously underestimated by the entire financial industry for decades. But Mandelbrot soon realized there was another crucial piece of this puzzle, another form of wildness that standard models completely missed. This insight came from an unlikely source, the ancient flooding patterns of the Nile River. For centuries, hydrologists struggled to predict the Nile's floods. They knew there were wet years and dry years, but couldn't find any predictable cycle. In the early 20th century, a brilliant British engineer working in Egypt named Harold Hurst spent 60 years studying the river. He was tasked with designing a dam capable of storing enough water to survive the longest possible drought. Conventional wisdom, based on the same random walk idea used in finance, suggested that a wet year should be followed by a dry year just as often as by another wet one. Runs of consistently wet or dry years should be rare and short-lived. But Hurst discovered something strange in ancient records of the Nile's floods. The runs were far longer than pure chance would suggest. Wet years persistently followed other wet years, and dry years clustered together. The river seemed to have a kind of memory. A wet year today was somehow mysteriously connected to a wet year from a decade earlier. When Mandelbrot learned of Hurst's work, he had a flash of insight. This was exactly the same pattern he was seeing in financial data. Price changes aren't independent events. Today's volatility isn't disconnected from yesterday's or last week's. This led to his second great discovery, which he called the Joseph effect. Remember the biblical story of Joseph, who interpreted Pharaoh's dream of 7 fat cows followed by 7 lean cows as prophecy. 7 years of abundance would be followed by 7 years of famine. This wasn't random fluctuation. It was a long, persistent trend with memory. The Joseph effect describes the market's tendency for trends, and especially volatility, to cluster together. You can see it clearly in price charts. Periods of wild, high volatility are followed by more high volatility. Quiet, calm periods breed more calm. There's a long-term memory connecting the past to the present. The market isn't a memoryless game of coin tosses. It remembers. What happened last year, or even a decade ago, still sends ripples affecting today's market. Now we have Mandelbrot's 2 great heresies, 2 forms of wildness that define his revolutionary view of markets. The Noah effect, the tendency for prices to make sudden, dramatic, discontinuous jumps. And the Joseph effect, the tendency for trends and volatility to persist stubbornly over long periods. One describes discontinuity, the other long-term dependence. For years, Mandelbrot saw these as 2 separate but complementary ideas. But then, drawing on his groundbreaking work in the physics of turbulence, he found a way to unite them into a single, powerful theory. He called it the multifractal model. This represents Mandelbrot at his absolute most brilliant, and the idea is both subtle and beautiful. He realized that the key to understanding markets was to stop thinking about time as a constant, linear progression, like a clock ticking steadily forward. Instead, he proposed that markets operate on their own unique trading time. Imagine you're watching a movie of market activity. During periods of frantic action, when prices are flying wildly and breaking news floods in, trading time speeds up dramatically. A single minute of clock time might feel like an intense hour of market action. Then, during quiet, slow periods, trading time slows to a crawl. An hour of clock time might feel like only a brief minute of market time. Time itself becomes fractal, It stretches and compresses like an accordion. This warping of time is the engine driving everything else. In Mandelbrot's model, two processes work together in harmony. First, there's a process that bends and folds rigid clock time into this uneven, multifractal trading time. Second, there's a more familiar process, similar to simple Brownian motion, generating price changes, but it does so within this warped, stretched trading time. The result is a perfect forgery of a real market. The stretching of time creates the Joseph effect, those long periods of high or low volatility. When trading time races forward, you get a cluster of large price changes packed together. When it crawls, you get a cluster of small ones. The combination of both processes generates the Noah effect, those sudden, discontinuous jumps. A small step in the simple price-generating process can become a giant leap in the real market if it happens during a moment when trading time is stretched to its maximum intensity. This is the grand synthesis, the beautiful unification. It explains both the fat tails and the long memory. It shows that markets aren't just simple random walks, nor are they simple trending systems. They're complex dynamic systems whose very fabric, time itself, is constantly shifting and morphing. This revolutionary view leads to what Mandelbrot calls his 10 heresies of finance, a direct assault on the old orthodoxy. First, markets are turbulent. They're not gentle, predictable machines, but wild, churning systems full of eddies and cascades, just like a raging river in flood. Second, markets are far, far riskier than standard theories imagine. The possibility of financial ruin isn't some 1 in a billion theoretical chance. It's a very real and present danger that the bell curve's comforting curves blind us to completely. Third, market timing matters enormously. Big gains and devastating losses aren't spread evenly across time. They're concentrated in a tiny fraction of trading days. Missing just a handful of the best days can destroy your returns, and being present for a few of the worst days can do exactly the same damage. Fourth, prices often leap rather than glide. They are discontinuous, jumping across gaps. This adds a dangerous layer of risk that models assuming smooth, continuous change simply cannot account for. Fifth, in markets, time is flexible and elastic. This is the core of the multifractal insight. Trading time is fundamentally different from clock time. Sixth, markets in all places and ages work remarkably alike. Whether you're looking at cotton prices in the 19th century or currency fluctuations in the 21 stone, the underlying fractal patterns of price variation are strikingly consistent. The machinery is essentially the same. Seventh, markets are inherently uncertain, and bubbles are inevitable. The scaling nature of markets means we can never be certain whether a trend represents real, sustainable change or just a temporary bubble about to burst spectacularly. This uncertainty isn't a flaw in the market, it's a fundamental feature of its character. Eighth, markets are deeply deceptive. Our brains evolved to detect patterns, and the long memory of the Joseph effect creates phantom trends and illusory cycles that fool us into thinking we can predict the future. These seductive patterns are fool's gold. Ninth, forecasting prices may be hopeless, but you can estimate the odds of future volatility. While you can't predict whether the market will rise or fall, the clustering of volatility means that if the market is wild today, it's likely to remain wild tomorrow. You can't predict the price, but you can predict the weather. And finally, the 10th and perhaps most philosophically profound heresy. In financial markets, the idea of value has limited value. We desperately want to believe in a true, intrinsic value for every stock or asset. But in a turbulent market, prices are driven by price differences, by arbitrage opportunities, by the chaotic interplay of millions of actors with vastly different time horizons and motivations. The price isn't a reflection of some hidden, solid, platonic value. The price is simply the price. This is the world according to Benoit Mandelbrot. It's a world stripped of the comforting certainties promised by old theories. It doesn't offer a crystal ball or a get-rich-quick scheme. In his own frank words, His work will not bring personal wealth, but it offers something far more valuable, a bracing dose of reality. It's a stark warning, a map of a dangerous, turbulent, and ultimately beautiful landscape. It tells us that the great ships of finance have been designed for calm seas, with shockingly little thought given to the hurricanes we know will inevitably arrive. And it calls on us to become better sailors, to respect the ocean's wildness, and to build fundamentally stronger ships. When you finish a book like The Misbehavior of Markets, it feels less like you've simply learned a new theory, and more like you've been given a completely new pair of eyes to see with. Suddenly you start noticing fractals everywhere. You see the turbulence, the wildness, the hidden patterns not just in stock charts on the evening news, but woven throughout the world around you. That, to me, captures the true genius of Benoit Mandelbrot. He did far more than just poke holes in outdated financial theory. He gave us an entirely new language to describe the complexity and roughness of reality itself. For centuries, science tried desperately to smooth over the jagged edges of the world, pretending everything could be reduced to simple, elegant lines, perfect circles, and symmetrical bell curves. Mandelbrot had the courage to look directly at the messiness of nature, at the jagged coastline, the chaotic weather patterns, the turbulent market, and say boldly, no, the mess isn't the error we need to correct. The mess is the reality, and it has its own beautiful hidden logic. What does this mean for us, especially for young people just starting to think seriously about investing, building businesses, or simply understanding how the world works? I think it leaves us with several profound and deeply practical lessons. First, and most importantly, it instills a deep and abiding respect for risk. The orthodox financial world can lull you into a dangerously false sense of security. It hands you numbers like beta and variance, and confidently tells you that you can engineer away your risk through clever diversification. Mandelbrot teaches us that this is a seductive illusion. The real world is a Noah's Ark world where devastating floods happen regularly. The biggest risks are the ones you can't see coming, those one-in-a-million events that the models insist are impossible. So when you build your career, launch your business, or construct your investment portfolio, don't just plan for sunny days and mild weather. Ask yourself the hard question, what's the absolute worst that could happen? Can I survive a biblical flood? Building that margin of safety, that deep resilience, is perhaps the single most important financial decision you can ever make. Second, learn to be deeply suspicious of averages. We're collectively obsessed with them. The average return of the stock market, the average price of a house, the average salary for a job. Mandelbrot shows us convincingly that in a world governed by power laws, averages are not just misleading but potentially dangerous. What really matters are the extremes, the outliers. In the market, a tiny handful of days account for the vast majority of gains and losses. In your career, a few key decisions or breakthrough projects will determine the overwhelming majority of your success. Don't get lost obsessing over the middle of the distribution. Pay careful attention to the outliers, because that's where the real action happens, where fortunes are made and lost. Finally, Mandelbrot's work teaches us to embrace a fundamentally different kind of knowledge. The old way of finance was entirely about prediction, about trying to build a perfect crystal ball to see the future with certainty. Mandelbrot shows us convincingly that this is a fool's errand. The market is too complex, too wild, too profoundly human to ever be predicted with any real accuracy. Instead, he offers a wiser path toward genuine understanding. You can't predict the price, but you absolutely can understand the market's character and mood. Is it currently in a turbulent, high-volatility state? Or is it in a calm, quiet period? Is it showing clear signs of long memory, of a persistent trend that might continue? Asking these questions doesn't magically give you the answer, but it helps you ask the right questions. It shifts your focus from a desperate, futile search for certainty to a wise, humble navigation of fundamental uncertainty. And that, I deeply believe, is a lesson that extends far beyond finance. It's truly a lesson for life itself. That was our journey through The Misbehavior of Markets by Benoit Mandelbrot and Richard Hudson. We've explored the core revolutionary ideas today. but I'll be completely honest with you. Any summary is like looking at a photograph of the Grand Canyon. It can show you the rough shape and the beautiful colors, but it can never capture the actual feeling of standing on that edge, the sheer overwhelming scale and magnificence of the real thing. The genuine magic of this book happens when you read it for yourself, when Mandelbrot's vivid stories and intensely visual way of thinking start to really click in your own mind. Consider this summary your map, helping you decide whether this particular journey is worth taking. If anything we've discussed today has sparked your curiosity or challenged your assumptions, I truly encourage you to pick up your own copy. Reading it isn't just about passively learning facts. It's an active experience that can fundamentally change the way you see the world of money, risk, and even nature itself. You can find a link to the book in the description below. Also, if you've found this exploration valuable and it's given you a genuinely new perspective, I'd be incredibly grateful if you would like this video and subscribe to the channel. It lets me know that these deep dives are actually helpful to you, and it ensures you won't miss our next journey into another potentially life-changing book from the billionaire's bookshelf. Let's keep learning and growing together.